Start start of a new week, and it's all rather grim as Wall Street's going down. In the last hour of trade, the Dow is off, or had been, more than 940 odd points lower. We're down at 734 down. The S&P, looking at the triple stack, shows off more than 100. That's pulled back, as indeed has the Nasdaq. They've all pulled back to where they're down pretty much similar and types. Chip makers with exposure to China are dragging it down. We've got Nvidia off 4%. That was 5 earlier. And you've got Micron off and AMD. Art Hogan is the Chief Market Strategist at National Securities. Art's with me from Boston. I am very wary, Art, as indeed are you, of doing the sky's falling, the sky's falling. However, when you can tie this to an event like Evergrande, I wonder, what do you make of it?
Yeah, it's such a great question. I agree with you. I think it's a whole lot less about Evergrande, and I think it's all about everything, right? And everything is China is clearly pulling back on corporations in almost every sector now, one at a time, putting new restrictions and grabbing back control of their economy. So I think that started at the beginning of the year. So, arguably last year with Alibaba, but certainly moving forward into this year, went after for-profit education, certainly went after online gaming for kids, regular gambling for adults, certainly big technology, and now levered land developers and clearly saying, okay, enough is enough. This is the way things are going to run. So I think that's the larger piece coming out of this Chinese story. And then you couple that with all the other things we've been concerned about modestly over the course of the month of September, which is historically bad for markets. Things like stubborn inflation, things like will the Fed taper or not? Certainly things like COVID, Delta 19 variants, and will that ever peak? And how much economic damage did we find in the wake of that Delta variant? So I think you put all of that together and in a month that has never been friendly to stocks, and you get this kind of a crescendo of selling.
Right.
I don't think it's Evergrande. I think it's everything.
Okay, but if it's everything, if we just look at it now from a US perspective, this, and bearing in mind the Fed meeting, the Fed are not going to be concerned with one day's movements, but they are going to be concerned about if there's something systemic building up.
Yeah, and so you'd have to make a case that the land developers in China that are highly levered are getting that leverage from U.S. financials, whether it's banks or non-bank financials that are lending into that, and they're not. We don't have exposure there. There's some small European exposure, but there's really de minimis U.S. exposure directly to any of the levered real estate players in China, and certainly the ones that are called into question today.
So the age-old question. For those who have been waiting to, quote, buy the dips, Morgan Stanley thinks this could be a bear market of 10%, a correction of 10, and may even be a bear of 20. Let's not worry about that. Is this a buy on the dips moment?
I certainly think it's going to be a buy on the dips moment over the course of the next 2 days. I don't think you need to rush in at the open tomorrow. We'll obviously have to sort some things out and likely get some margin calls again tomorrow to sort this out. But I think, the majority of the damage will be done by Wednesday. And just hopefully you wrote yourself a note that said, hey, Richard, I'm going to buy if we ever get a 10% pullback because I've been out of the market for too long, and here are the things I'd really like to look at. If you left yourself that note, go back to the page in your notebook where you left that and remind yourself you've been waiting for this. This is likely a buying opportunity. A lot of this has nothing to do with the United States and the U.S. equity markets unless you're selling a lot into China or levered to China and need a lot of exports from them.
Gosh, that's extremely useful advice in difficulties, because absent the Chinese issue, and bearing in mind that monetary stimulus in terms of low interest rates continues for the foreseeable, and we are nearly at full employment, and the Fed is tapering, but there's been no taper tantrum, it's perverse to assume it's going to collapse.
No, I think that's right. And I think the most important thing to look at is how do we stand in valuations right now, and how do we stand technically? So technically, RSIs look like we're getting oversold. The Dow is below 30, oversold. The S&P is at 30, getting close to oversold. The Nasdaq's at 33 on the bell here, and that looks like it's close to 30, which would be oversold. So technically, we've done a lot of damage in a short period of time. But fundamentally, if you look at the forward 12 multiple of the S&P 500, it's trading at just about 20 times. It was 23 times 7% ago last April. Earnings are going up. Earnings estimates continue to go up. So I think this is a market that 4% off an all-time high looks cheaper than it did 3 months ago.
And we'll talk more about those forward and trailing earnings and EPSs, because I think that's important for us to understand PEs. When they've been elevated for so long, they're starting to come back, and whether or not we are at that equilibrium that makes sense to go. And thank you, sir. I'm grateful.